I think that you could do worse if you've got 500 million of, of cash, and you're a private investor and you're looking for, looking to look after that capital. There is nothing wrong with core real estate in core cities. So I would probably, buy London, and I think that London has a great story. Maybe it's not going to give you, huge, private equity returns if that's not, what you want. But I think I would stick with, central CBD assets in major cities. And I think that some of the German cities, the Munichs, the Hamburgs. I think Berlin is one that would be, slightly higher up the risk curve, but I would go to. So I think that I would stick to core CBD. And that would give you safe, secure, long-term protection.
Okay, good. I've got 500 million now in a nice, safe, secure place. I'm beginning to feel a bit more risky, Joss.
Yeah, I think
I forgot about the fees. Sorry.
Oh yeah.
Yeah. I think your presentation was right. I think I'm really an opportunity guy, and I think that what opportunity funds need is economic growth, GDP growth, and debt. And if you've got those two things, opportunity funds can make money. And so I think I'd be going up the risk curve in opportunistic. And I think I'd be looking more at sort of private equity type investing. So buying into real estate operating businesses at this point, creating, developing, refurbishing, repositioning. And you could be doing that by either buying entities that are capital starved and still in the hands of banks, or in the hands of Lone Star or Cerberus, or looking at new asset classes that you could emerge through Europe, like self-storage, senior living, student accommodation, healthcare, that kind of thing. So I think I'd be doing that with my 500 million.
Great. Richard?
I think diversification is key. I wouldn't stick all of your $500 million into just one asset or one asset class, one individual place. I'd spread it around quite a bit. Europe's quite a big place. There's a lot of opportunities out there, but obviously you do need some focus as well. I think the UK is looking pretty good. Actually, if you'd have asked me the same question 6 years ago, and then look at how much money you would have made, you'd have made a killing. Putting it into the UK, this is sort of preempting IPD numbers which haven't yet come out, but we're pretty close to the end of June, end of Q2. The IPD quarterly index is almost certainly going to show a 100% return since the low point of mid-2009. And that's set to continue as well. The strength of the UK market is pretty strong. The GDP consensus view is that it's going to be the strongest economy in the G7 group of advanced major economies. So not just London. I think the UK market is again, it's a big place, and London, core central London, looking fairly overpriced, and I think there are better opportunities around. Edge of London, fringe of the core, I think there are angles there, but also going out into the regions of the UK. In continental Europe, again, being a bit aware of the risks. So the UK, and I think in continental Europe, Germany is looking fair prospects going forward, and some of the Nordics as well. You have to be a bit careful when you look at what's happened to oil prices over the last year. So Norway, for instance, has suffered a bit, but Sweden looking pretty strong, and maybe a bit of a punt on Spain. I think there's good prospects there.
I think seeing the consolidation in the retail investment market, seeing the structural changes, I would buy actually into a large portfolio of high street retail across major cities in Europe. So that would what I would do if it would be my money.